I am OG John Original. Tonight, a convergence of major economic signals is sending shockwaves across global financial markets. A deeply disappointing United States jobs report, crude oil prices breaking through significant technical levels, and mounting physical shortages in the global silver market have all collided in a single trading session, painting a picture of significant structural stress across multiple asset classes simultaneously. Beginning with the headline numbers, the United States economy shed 92,000 jobs in February. That figure stands in stark contrast to analyst expectations, which had forecast a gain of 58,000 positions. This was not a minor deviation from projections. The economy moved in the opposite direction entirely. At the same time, the unemployment rate climbed to 4.4%, exceeding the consensus estimate of 4.3%. Yet despite the job losses, average hourly earnings continued to rise, posting a gain of approximately 4%. The simultaneous occurrence of rising unemployment and persistent wage inflation carries a specific economic designation: stagflation. Compounding the domestic economic picture, Brent crude oil broke above $90 per barrel for the first time in 2 years, with West Texas Intermediate sitting at $87. Qatar's energy minister has publicly warned that oil prices could reach $150 within 2 to 3 weeks, depending on conditions in the Strait of Hormuz. Natural gas prices, according to those same warnings, could rise by as much as 400%. In the metals markets, silver's physical inventory across 3 major global exchanges, in Shanghai, New York, and London, is draining at an accelerating pace, with the Shanghai Futures Exchange now carrying roughly 15 days of supply remaining at current withdrawal rates. Equity markets responded sharply to today's data. The S&P 500 fell over 1%, the Nasdaq dropped approximately 1.5%, and the small-cap Russell Index declined more than 2%. Government bond yields fell in tandem, a simultaneous decline in both stocks and yields that market observers are reading not as a signal of coming rate cuts, but as a warning of broader economic deterioration. Turning now to a more detailed examination of the economic data and what it reveals about the Federal Reserve's current position. The February jobs report did not merely disappoint, it inverted expectations entirely. A forecast calling for 58,000 new positions was met instead with a loss of 92,000 jobs. Unemployment rose to 4.4%, and yet, average hourly earnings held firm at a 4% annual rate of increase. That combination places the Federal Reserve in a position with no straightforward exit. Cutting interest rates risks accelerating inflation, which remains elevated. Holding rates steady risks deepening job losses in an economy already shedding positions. The Fed faces rising inflation and rising unemployment at the same time. Additional data reinforces the concern. Retail sales fell 0.2% in January, and consumer spending showed no meaningful growth during that same period. Americans have reduced spending while prices continue to rise, a dynamic that directly contradicts the soft landing scenario the Federal Reserve had projected over the past 2 years. The bond market's reaction today is worth examining carefully. When both equity prices and bond yields decline simultaneously on the release of weak employment data, it is not conventionally interpreted as anticipation of rate cuts. Instead, analysts view that pattern as a signal of concern about the broader trajectory of the economy. That shift in how markets are interpreting incoming data represents a significant change in the prevailing financial environment. Layered on top of the domestic economic data is a rapidly evolving geopolitical situation centered on the Middle East and its implications for global energy supply. Brent crude oil crossed $90 per barrel during today's session, a level not seen in 2 years. West Texas Intermediate stood at $87. These moves are occurring against the backdrop of heightened tensions involving Iran, with reports that the United States has stated unconditional surrender as the only acceptable outcome, ruling out negotiations or a ceasefire arrangement. Qatar's energy minister issued a direct warning that oil could reach $150 per barrel within 2 to 3 weeks if tanker traffic through the Strait of Hormuz is disrupted. The same warning cited a potential 400% rise in natural gas prices, and noted that continued conflict could deliver a measurable blow to global gross domestic product within weeks. Kuwait has begun reducing production and is reported to be discussing limiting output to domestic consumption only, placing approximately 2.6 million barrels per day of production at risk. Oil storage facilities across the Gulf region are reported to be at capacity. Additionally, Russia is reported to be providing Iran with real-time intelligence on the locations of United States ships and aircraft. Iranian officials have stated that forthcoming military actions will be broader and more intense than previous ones. The inflation implications of these energy market developments connect directly back to the Federal Reserve's dilemma. Each $10 increase in oil prices adds approximately 20 basis points of upward pressure on inflation. Oil has moved from the mid-$50 range to $87 during the current period, a move that, by that calculation, has already added more than 1 full percentage point of additional inflation pressure. At $100 per barrel, analysts project the consumer price index could push beyond 3%, even as unemployment continues to rise. Shifting now to the silver market, where conditions in the physical supply chain are drawing increasing attention. The Western spot price for silver stood at $84 during today's session. The Shanghai spot price was quoted at $96, a premium of $12 over the Western benchmark. That premium, however, is secondary to what is happening inside the vaults themselves. Since October, the Shanghai Futures Exchange has seen its silver inventory fall by 77%, declining from 36 million ounces to 8.2 million ounces. In a single session on the day prior to this report, 539,000 ounces were withdrawn. At that rate of drainage, the Shanghai Futures Exchange vaults are approximately 15 days from being fully depleted. The Shanghai Gold Exchange tells a parallel story, with silver holdings down 64% from 39 million ounces to 14.3 million ounces. On the COMEX exchange in New York, registered silver inventories have declined 34% over the same period, and are now at an estimated 91 days of supply at current drainage rates. 3 separate exchanges, on 3 separate continents, are simultaneously recording multi-year inventory lows. Silver backing COMEX futures contracts has been declining by approximately 20 million ounces every month for 6 consecutive months. COMEX silver open interest has reached a 12-year low, and trading volume has contracted sharply. In response, the CME Group cut silver futures margin requirements by 22% in a single adjustment, reducing the cost of holding positions in that market. Gold open interest on the Shanghai Futures Exchange has also fallen to a 3-year low, indicating that leveraged positions are being unwound broadly across precious metals paper markets. Silver's price moved from $81.60 at the opening to $84 by the New York session close, a recovery of approximately 3 to 4% within the trading day. Gold stood at $5,149, having spiked sharply on the 8:30 a.m. release of the non-farm payroll data before giving back those gains within 15 minutes, then recovering again as the U.S. dollar softened through the session. The U.S. dollar index showed signs of weakening on the charts, though analysts noted that a clear directional trend had not yet been established. A regulatory development out of India is also drawing attention from market participants. India's securities regulator issued a formal circular, effective April 1st, requiring all mutual funds and exchange-traded funds holding physical gold or silver to cease using the London Bullion Market Association fixing price as their valuation benchmark. Domestic spot prices from Indian exchanges will be used in its place. The regulator's stated rationale is uniformity. The development follows 2 separate episodes in the past 6 months, in October 2025 and again earlier this year, during which domestic Indian silver prices detached significantly from London prices because physical metal could not be delivered from London quickly enough to meet Indian demand. The arbitrage mechanism failed, prices diverged, and India's financial regulator has since revised its rules to reflect conditions in the physical market rather than the paper benchmark. India is one of the world's largest consumers of silver. To summarize the developments of this session, the February jobs report recorded a loss of 92,000 positions against an expectation of a 58,000 gain, with unemployment rising to 4.4% and wages remaining elevated at 4% annual growth. Brent crude oil crossed $90 per barrel for the first time in 2 years, with Qatar warning of a potential rise to $150 within weeks if the Strait of Hormuz is disrupted. The Federal Reserve now faces simultaneous upward pressure on inflation and rising unemployment, while retail sales and consumer spending data from January point to a contraction in economic activity. In the physical silver market, inventories on the Shanghai Futures Exchange, the Shanghai Gold Exchange, and the COMEX have each recorded substantial declines over the past several months, with Shanghai vaults at an estimated 15 days of remaining supply. COMEX silver futures open interest has reached a 12-year low, and the CME Group has reduced margin requirements by 22%. India's securities regulator has formally directed funds to move away from the LBMA price benchmark, effective April 1st, following repeated episodes of price dislocation between London paper prices and Indian physical market conditions. These are the confirmed developments across the jobs, energy, and metals markets as of this session. Investors and analysts will be monitoring COMEX registered silver inventory reports and CME margin positioning data in the sessions ahead for further indications of how these structural pressures resolve. We We will continue to track and report on each of these developments as additional data becomes available. That is our report for this evening. Thank you for watching.